Uncertainty in policy and economics is bad for the stock market. Lack of uncertainty is very good. We're going to show you a unique indicator that no one else has shown you.
We'll talk about in this episode of Altimetry Authority why we think that means big things for the stock market for the rest of the year and why you should be really bullish. Today on Altimetry Authority.
Stock earnings and favorite pastime.
So let me just say, earnings
Wall Street
is
2.5x
because their compensation goes up.
Wall Street's wrong again. McLaren IPO was just one of many that has hit the market recently. You've had CoreWeave, Figma, Klarna, Circle, huge IPOs that have been really telling everybody that maybe the tides are changing. Because if you look at it, I mean, we've got a whole bunch more that are up, that are coming down the pike too. We've got Gemini, the crypto exchange. We've got Stripe potentially IPOing, Chime, Discord, StubHub, Cerebras. And you look, right, everybody in the US IPOs currently are trending below where they had been for most of the last call it 15 years. But there's a real reason why you saw a surge in the last month or two of IPOs and why it's looking like the rest of the year is going to be a banner time. And it all has to do with uncertainty. Right, and so this chart, right, is just for context, everybody, really great research that came out from survey work from Apollo with corporate management teams. And they went to corporate management teams and they asked, hey, how are you feeling about trade policy? What's the level of certainty you have? And they tracked this over time, right? Data that they have from surveys they've done, from the Economic Policy Uncertainty think tank, et And what you see that everybody would pay attention to on this chart is, holy cow, right, Joel? Man, that is a crazy spike in trade policy uncertainty. But Joel, it's something else, right, that we think is really important, which is why we're going to potentially see a surge in IPOs, and it's this, right?
The fact that it's coming back in, meaning there's a big scare as to what might happen, and you had the media all over, tariffs and whatever, the worst things in the world, and you had an administration re-examining every trade policy with every trade treaty with every major player. Of course that creates massive uncertainty, and it gets people to sometimes put a pause on investments and what have you and new initiatives. But that has come flying back down. As people say, all right, we have an understanding what it is. It's nowhere near as bad. We did not have a recession in June, even though 95% of what economists said that the trade tariffs are going to result in a recession for sure. It's absolute. The stock market's going to be in a bear market come 6 months into 2025, and literally the opposite has happened. And we're seeing that as this uncertainty falls, it bodes very well for some really interesting opportunities.
Right, because we all assumed back, if you go after the election in November, everybody said, oh my goodness, we're going to have a banner year for every single thing for corporate action because, right, this administration is focused on deregulation. But this right here helps explain why. And right, if you look broader economic uncertainty in terms of economic policy uncertainty, yeah, you saw a massive spike like we hadn't seen really since 2020 in the middle of COVID when everybody didn't know what was going to happen. And so what happens is corporate management teams hate one thing worse than bad news, just like investors do. They hate uncertainty. And when they have uncertainty, guess what they do? They put their hands underneath their butts and they just sit and they wait. They wait and they wait and they wait because they don't have to spend money if they don't want to. Well, when you get the rate of change that we're seeing now in terms of what's happening, in terms of just people having less uncertainty, that makes those people with, right, itchy fingers trying to reach for their wallets all of a sudden start to. And Joel, we started to see this really show up in our earnings call forensics work in just the last 2 or 3 months, right?
So when we look at our earnings call forensics, which we run company by company, we've run over 60,000 earnings calls and other management presentations, including, by the way, Jerome Powell's, right? And we run them, and we run through an electroaudiogram. It's basically like a voice stress analysis, and we've tested this over years. It's unbelievably accurate, but it's not accurate in telling you buy the stock or don't buy the stock. It just gives you the sentiment of management. And if management is showing a lot more, we'll call them concern markers or highly questionable markers, or frankly, markers of deception because they don't know how to answer the question or whatever, and it shows up as deception if they try to BS their way out of something, we'll get these highly questionable markers. So when we take the confident markers and we divide by the questionable markers, we get a ratio. And what we're seeing is a confidence to concern ratio that is one of the highest we've measured going back to, what is that, Rob? 2013, 2014?
2012.
I mean, this is 2012. This is one of the best and highest. So this is a massive sea change in management sentiment, which we believe will translate to management investing, into management expansion. I mean, management and corporate expansion, and a lot more M&A. And we're seeing it in IPOs a bit also.
Mm-hmm. And so, right, everybody, why is this important? Because that inflection is really important because of how it covers management's willingness to invest. So what this chart is when we look at uniform accounting, when we do what we do to restate the financial statements, make 130 different adjustments to get what real economic profitability is, what real economic growth is, and investments are for corporates, we can track what we call depreciating assets. That's, the buildings that you own, that's the data centers you own, that's the trucks and transportation you own, that's also the leases you have and the R&D investment you're making in the future for your business. And what you can see is those blue bars are what the aggregate level of investment of depreciating assets, those assets that you have a finite period of time to use them in, and as you use them, you use them up. You can see U.S. corporates in aggregate have almost $25 trillion of hard asset investment and R&D innovative investment they've made. That red line is the rate of change year over year. And what you can see is in the 2010s, we were averaging mid-single digits in terms of growth rates each year. We weren't investing a lot. We were investing, but not a lot. In the last few years, as we've seen a combination of the supply chain supercycle, the AI boom, and everything else, we saw that investment rate accelerate. But in 2025, that last bar, that's an estimate. And the estimate has been, because of all the uncertainty out there, that we were going to see a slowdown in the rate of growth that we were seeing. But when we see all the stuff that we just talked about in terms of economic uncertainty being relieved, all that tells us we're likely not to see that slow down. We're actually likely to see it accelerate even more because of the fact that there's so many reasons between the deregulation agenda that's going on and the surge in AI and everything else that we're going to see accelerating investment. And Joel, right, that's so important because for the last few years, when we look at uniform accounting's earnings growth and we clean up the earnings, right, we've seen around a 9% CAGR, right, compound annual growth rate, everybody, how fast it grows every single year. Basically, since 2019, 9% a year. And that's forecasted to continue for the next 2 years. But what the market is pricing in, that's this white bar here, the market's only pricing in 7% growth. And so, Joel, it looks, I think you would agree, like the market is pricing in the uncertainty and unwillingness for management teams to invest and missing that marginal inflection that we're seeing that could be a catalyst.
Yeah, if the market's pricing in a 7% per year, right, and you're saying it's going to be closer to 9%, that means the stock market still has upside, right? Mm-hmm. And if the company's even surprised on that, given these crazy confident markers that we're getting from management teams, you might see what really is a 10 or 11, 12% growth rate, which is highly possible. It's happened in the past. Why can't it happen with the AI boom and productivity and all the changes in economic policy that we're seeing that are bringing a lot of businesses back in the United States and what have you? Not to mention tax cuts, which leave more money for the consumer to be able to spend on things. Why can't it be even 10, 11, 12%? If that's the case, this stock market is incredibly undervalued, despite people saying, no, it's in a bubble and get out and put more of your money in gold and cash and whatever else. And we're like, no, this is the time to hold on and ride this market for another, what could be 2, 3, 4 years of this, kind of like 1997 to 2000.
Right. Everybody, when a momentum market gets going and driven by fundamental momentum, and because of all the things that we just talked about, fundamental momentum is accelerating, that's a time to buy the market, not be worried about it topping out. And so if you enjoyed that, drop a comment in. If there's another big picture, if there's a reason why you think we're wrong, tell us. We'd be happy to talk about it in a future episode. Or if you think we're right and you think that we're missing a big data point, tell us too. We'll cover that in a future episode. Hit the like and subscribe button, and that's this episode of Altimetry Authority. Thanks, everybody.
Thank you.